Hey, good morning, everybody. Welcome to another daily market report brought to you by Mike Bjork. Today is Friday, December 7th, and we got the important day today, the jobs numbers. So we're going to jump right into it. We got the non-farm payrolls for the month of November. We had in October 138,000 new jobs created for October. Uh, for November, they figure it kind of decreased to about 80,000 jobs, and it came in at a whopping 146. So. Uh, but be cautious with that because if you look down the jobs numbers, about a third of that, 53,000, were for retail. And if we remember from past history, retail do usually beef up around November for the holiday sales. So those are temporary jobs versus actual permanent jobs. And then also keep in mind we have Hurricane Sandy, which some of that stuff could be construction with the cleanup and everything else that's going on the East Coast. When they got hit by Sandy, we could they could have done more jobs in that area as well. So be cautious with that, as some of those could be temporary jobs versus permanent positions. So that brings us to the unemployment rate. And we had a 7.9, the forecast show 7.9, and it dropped to 7.7%. So what that really tells us is that it's not getting better. It's simply that people are getting disinterested and they're dropping out. There's no way with the 146,000 or about 100,000 jobs per month, it's going to lower our unemployment rate because we got people coming in from college, people that were laid off, trying to look for work. There's no way that would that would be enough to be able to decrease the jobs numbers. So this is basically showing us that people are um, basically dropping out of the job market, at least probably for the holidays or so, as a lot of employers are also saying that they're not doing any hiring until we get a resolve with this fiscal cliff that's going on right now, as they don't know what kind of tax basis that they may have as such. This is going to affect them as well, especially in the defense, the government contractors, as they have a sequestration, and they could be out budgets as well, and may not be. They may actually be on the layoff side of things. Another thing here is we got the consumer sentiment. This is a huge number. We had 82.7 back in November. That was the final tally. Remember, we have an initial at the beginning of the month, and then towards the end of the month we have a final number. So the forecast for this month was 82. That would be in the same range, and it dropped all the way down to 74.5. This is the biggest drop we've had in about a year and a half, going from like 82 down to 74 and a half. So that's a pretty big drop right there. So this is telling that consumers are getting a different outlook of what's really going on out there, and this is, of course, post-election here. So maybe things aren't as bright as they thought were leading up to elections. Let's go ahead and take a look at the headline news. The stocks are a little bit mixed. The stocks started up higher when they saw the jobs numbers. They liked, of course, those job numbers. And so as a consumer sentiment, it kind of dampened that. But the biggest thing that, of course, they're still kind of watching is more fiscal cliff. I'm sure we're going to be sick and tired of listening to the fiscal cliff. There's still no progress. So people are getting kind of tired of that. Then some additional news that came out earlier today was Germany kind of lowered their 2013 economic forecast for. So obviously that doesn't bode well, as we're all kind of intertwined, and Germany's the largest economy in Europe, so that's going to affect how Europe does business. So let's go see what the bond market's doing and what interest rates are doing. So as I mentioned last couple of days, be careful, get ready to, if you're floating your interest rates, to maybe get ready to lock, as we could be due for a correction. Now this has been a pretty strong ceiling for the past month or so. Every time we touch this area, we've kind of gone down. As we've seen here, we touched, even back here we've touched, and we touched here, and we had a nice drop down here. So we had a worsening in the interest rates, and then we have an opening gap on the lower side and then basically, so rates are worse today than what they were yesterday. So we had a worsening in the interest rates. We could have a correction. I could potentially see it down to around this level, 104.40-ish, and this level here correcting, and then maybe work its way back up. I think this is a short term where we might see a correction. So we may have rates kind of going upwards a little bit for short term, and then it'll kind of even itself out in long term. I think we could see some improvement in the interest rates. But as of right now, interest rates are worse than what they were yesterday. We're back to levels basically about a little over a week ago, or about a week ago. So if you look at the levels where we stand for interest rates. All right, folks, you guys have a wonderful weekend. We will see you guys on Monday. Thanks for stopping by. And if you guys like to see these videos, have these emailed to you on a daily basis, just stop by mikesdailymarketreport.com. There is a subscription up there. You can just put your email address in there. We don't share this information, and this is the only thing you'll receive from us is once I upload these into the blog, they'll be emailed to you. All right, have a wonderful day, and we'll see you on Monday.